Hello, everyone, and welcome to today's major markets update for Friday, May 6, 2022. I know this says April 29th, 2022, but this is the slide from last week where I said so far so good, but be wary of the curveball. Excuse me. I'm suffering from a severe cold, so please pardon the once occasional coughing and my quite nasal tone. I should barely be actually speaking, but I want to present you this update anyway, because I think on Wednesday during Fed Day, we got the proverbial curveball. As I always say, you get about 3 or 4 out of 4 or 5 calls correct, and then the market does something else, and you need to get back to the drawing board and understand what's going on. So we got the curveball from last Friday. We got it on Wednesday. So we got the curveball, or as I say, the Bulls fumbled the ball at the 90 yards line or wherever the line is. This is Tom Brady's, I think, highly disputed fumble over the last 24 hours on social media. So was it truly a fumble? Yes or no? But that fumble was, of course, we had a almost breakout on Wednesday, but we did not get above the key levels it had to break. Those were the blue lines on the chart. It did not break above those on a daily close, and that's where the bulls fumbled. And so we got the curveball, right? So I have 3 different opening slides because all of them kind of capture where I want to go. We get these curveballs thrown once in a while by the market, but don't worry, when we get thrown off the horse, we climb quickly back on top of it. And let's go to the charts and see what that curveball is. So here is my reassessed chart for the S&P 500. On Wednesday, we rallied right back on last week's high, but we failed within a couple of cents, literally. So I think that was wave 4, and we're now in wave 5. What this means is that we had a irregular flat minute wave 4. Then the step lower on Monday fits better with wave 3, as that target is almost closer to the ideal wave 3 zone of 40.80. We got 40.62, so off by 18 points versus 40.41, which is off by 21 points. And then we get the wave 4 back to the 76.4% retrace, and now impulsing lower to complete, hopefully and ideally, wave 5 of CO4. I say hopefully because, as you always know, this is an interpretation of the price action. Today, a member of ours and I have been discussing in length what type of correction we are seeing. It is a very complex correction. The decline into the January low, which by the way is not that far off from the current lows. The current low was at 40.62 or 40.67. The January low was about at 42.25, so it's really not that far off, only 5% lower. Look what the market has done in the meantime. It's up, it's down, it's up, it's down. Compared to here and here, very little progress to the downside. Compared to February and now, even less downside progress. So that is interesting. So this is a very overlapping type of pattern. Into the January low, I can only count 3 waves lower. So back here in January, we had technically done enough damage to the downside in price and done 3 waves lower to assume that this was potentially a wave 4. Remember, after 3 waves lower, always expect at the minimum 3 waves back up. So this is where we started to track a potential impulse. Okay, what threw me off was that we did not get the 4th wave, so to say. We could have done 1, 2, 3, 4, and 5. So we didn't get that. But we went lower anyway. We got the overlap, but this was all 3 waves and then 5 waves lower as a diagonal. Then we got the February low. So expect 3 waves back up, and we did only get 3 waves back up. Once we started overlapping with the previous late January highs, we knew it would go lower. You can then start making projections how low it goes. And here we then have made 3 higher degree waves lower. These are 3 lower degree waves lower. Now we have 3 higher degree waves lower. 3, 3, 5 type of correction. Again, this could have been considered complete. We start tracking it, and here in late February, I did a presentation called I Spy with my little eye 5 waves higher. So you label it as 1A, and then you measure the pullback or track the pullback for 2/B. And then we got the rally into the ideal wave 3/C target zone. And then we anticipate a wave 4 and a wave 5 if this is going to be an impulse, as long as price doesn't break below the wave 1A high, because fourth waves and first waves are not allowed to overlap. We got that overlap in April 10 or 11, somewhere around there. And then we knew this was not an impulse anymore, but turning into a double, potentially triple type of correction. So we have a 335 lower, a 535 higher, and now a 5 lower. Is this maybe some sort of flat? The B wave should ideally go a little bit higher for a flat, but maybe we need to adapt some of our definitions to it. Regardless, a lot of people would label this as a WXY. It just shows you how complex corrections can become and how you continuously anticipate, you monitor, and you adjust. 3 waves lower, anticipate 3 waves back up at the minimum. That's what we got. You get the overlap, look lower. Now we got 3 bigger waves lower, etc. Once we topped here January 4th, nobody knew this would develop like this. Nobody knew. What we did know was that we would go lower. So we hadn't done enough damage already in January. So it's logical to start looking for higher prices. Same here in February. And again, we're marginally lower. The alternative to this 5-wave developing, of course, to the ideal downside target 40.41, 39.78 on the S&P 500 remains in place. Excuse me. That's my cold cough. Is that we have indeed, though, still completed 5 waves lower at Monday's low, and we're going to do an irregular flat B wave and then another C wave. We're going to mirror the whole corrective pattern from January into February, an ABC and an ABC. This would then be a double type of zigzag correction, and this would be WXY according to the Elliott Wave purists. So this is the alternative count. Remember, with Elliott Wave, you have your preferred count and you have your alternative count. There's never only one option. At the minimum, there are always 2 options. So the preferred path is for this simple impulse lower, where I had to reassess the previous high at 43.07 as a minute 4 instead of a minor 4. And this is where we go. We anticipate, we monitor, and adjust. On Wednesday, I said, now we're going to track for 5 waves higher. This was a very strong, big candle. We didn't get 5 waves higher because we started overlapping. At the open, the market had the choice to turn the low price at the open, so to say, the gap down at the open, as a small little 4th wave. But then it decided to overlap already with this high of the previous day, and that pretty much took the entire potential impulse path off the table. That's why I said on Wednesday, now we can start tracking for an impulse higher, because we had a 1-2, 1-2 setup in place, which was a ABC, ABC pattern. That's what it morphed into. Credit to one of our members who offline after the webcast on Wednesday said that somebody he tracked said that we would top reasonably soon and then crash out of bed, so to say. So that truly happened on Thursday and Friday. I didn't see that. I'm sorry. Again, I can't get everything right. I nailed the top here. I nailed the bottom. Let's see here. I nailed the top here. I nailed the bottom here, top here. And again, can't get them always right. That's just the way it is. There is no perfect forecasting method in the world that gets every single turn correct. So moving on then to the futures market. Also the futures market, we had the first warning for the bears at this level. It broke. The second warning was at this level. It broke. The third level, to say that the question mark wave 4 is in, was at this level, at exactly 43.0325. How high did we get? We got to 43.0275, 50 cents below it, and here 4,300. So we did not break above it. We did not get above it, so we did not get the confirmation. So this then has to be morphed into a more complex 3, 4, 5 pattern. What has thrown me off is the interpretation of these few hourly candles. And this is what I mean. Elliott Wave remains in that sense still objective. How you're going to interpret at some point some little bit of price action. I had this originally as a 3 and a 4, and this as a 3 then, and this as a 4. Okay, but this interpretation of the price action was, for my part, wrong, and we have a better impulse this way. What we also can see is that at the low earlier this week, we went to the 161.8. It held again today, but I think we have a nice potential path here lower to this ideal wave 5 or 5 or C of 4 target zone. So again, this low here, which is closer to 161.8% extension, fits better for a wave 3 than a wave 5. And then the move back here again to the previous 1 degree lower fourth wave, which is close to the previous 1 degree fourth wave below that as well, micro, minute, minor, really suggests that we can move lower to 3960, 4024. Wouldn't surprise me. This price action here is a little confusing. What does it take to confirm the low is in? Of course, we need to break above these levels now, right? Very simple. Need to break back above last week's high, which is equal to this week's high. Moving on to the Dow Jones. The Dow Jones needs then a quick reassessment as well, that the spike high we had last week wasn't wave 4, but it was only wave A of 4 of an irregular flat wave 4, 3, 4, 5. The target zones are the ideal Fibonacci-based target zones for wave 3, wave 4, and wave 5. Again, the market doesn't have to be ideal, but it topped here right where it should. It bottomed a little bit below it, and now we're right here at the lower end, but we might need to go a little bit lower. That's fine. What will it take? Of course, it will take a break back above the previous fourth wave high, this week's high, just as we had last week. We needed to break above last week's high, and we didn't. We got right there. But this is now, of course, a loud and clear line in the sand for the bull versus bear battle. That is the level we need to watch for more certainty that we have indeed completed this low. On a line graph, this still looks better like an A, a B, and a C, and this is a, I would say, double zigzag, A, B, C, and then zigzag, and probably another 5 waves lower. A very weird, complex correction. Wouldn't surprise me that I am not even able to know exactly what it is. I would say welcome to fourth waves. Here we have the Nasdaq on Wednesday, or sorry, on Monday, we had completed 13 waves. Remember, impulses travel in 5, 9, 13, 17, 21, depending on if they subdivide or not. Here we simply measure closing prices as waves. We don't even look at the wave degree. And again, we did not get above this blue line. This was the cutoff line. We closed right at it, and the bulls completely fumbled the ball. This is where we got the curveball. Not only, so we combined two sports, right? Again, from a trading perspective, this was easy. You nail 2 out of 3 trades pretty well with Elliott Wave. Then there's always one that throws the curveball. That's okay, as long as you not change any of your trading methods with position sizing and stops and all that stuff. Having 2 out of 3 trades correct is much better than going to Las Vegas, where your odds are only 49.5%, I believe, at best. So 13, 14, so I'm looking for 15, 16, 17 to complete a impulse. Why? Because you have at the minimum 5. If the third wave subdivides, you add 4 waves is 9. If the fifth wave subdivides, you add another 4 is 13, etc. All right, subdivisions of waves add 4 waves to the impulse pattern. Now we also have a third wave that's a slightly smidge longer than the first wave. Excellent. So now the fifth wave can do whatever it wants to do. I like it. So this looks all really good. So now we've covered the S&P 500, the futures market, the Dow Jones, and the Nasdaq. And we're going to look here at some of the other indexes that I covered a while ago, stating I'm missing a fifth wave. Some interpreted that as a fifth wave has failed, or a missing or failed fifth wave. No, it's not. I'm still missing it. So this is the S&P 500 equal weighted index. We're still nicely in this ideal wave 4 target zone box. Nothing has changed compared to even February. We're pretty much at the February lows, so this looks pretty good. We still expect a final fifth wave. Look at the NYA or the NYSE. Also, this one suggests that we can still head a little bit lower. As I showed you, we can go to 14,680. Question mark is if the third wave top was here in January or here. It's a little bit potato. What we since have seen is a very corrective price action. I have a hard time turning this into a 1-2, 1-2, 1-2 type of nested bearish setup. Especially here for the S&P 500, I don't see a 1-2, 1-2, 1-2 setup at all. But maybe my classes are colored. I don't know. I have a hard time seeing it. Obviously, also for the NYA, if the NY can break above this trend line, I think we're looking mighty fine for this last fifth wave. Mid cap, I have the same potential path. We're not even anywhere below where we shouldn't go. Looks also still good. Yes, we're leaking lower, but also this looks all corrective to me. This is the value metric index. Also here, we're still in the normal typical fourth wave target zone. So all this remains still in play. The only one that could consider we've topped is the small caps. That's the only one. We're still though in the normal wave 4 targets retrace zone. Preferably, I look at this as something like a very complex ABC type of long-term pattern. Excuse me. Now, if you find all this trading with Elliott Wave difficult, if it's not accurate enough to have these target zones met for buying and selling, especially Wednesday could have thrown the proverbial curveball, but again, on Wednesday we did not close above any of the key levels that we're looking for. Those are your triggers, right? This is the condition that it is potentially a top, but we haven't had the trigger yet, right? The condition was, okay, we've potentially bottomed. Sorry, I said top. We've potentially bottomed, but we haven't had the trigger yet. The trigger needs, of course, to be closest above, and even those are still not guarantees. They can always morph into something else. You always adjust your stops accordingly. And if you have still difficulties with that, just click on my trading alerts, and you'll get trading alerts 10-15 minutes before the close to tell you which ETF to buy, sell, or hold. I can't guarantee only winning trades. It's impossible. But this is the performance of my trading systems for the NASDAQ100 and the S&P 500. I do the Dow Jones, the semiconductors, and the Russell 2000 using the IWM, etc. And you can see that we're highly outperforming the markets. Yes, short term, my system is down year to date, 6%, but intermediate term, it's up 11%. So the average is up 2%, whereas the actual index is down 21%. If 2% versus 21 down percent is not good enough for you, I don't know what it is. And maybe you're doing great. This is just a simple way for if you have difficulties with trading, this will teach you at the minimum discipline to just follow and execute the signals. You get the signals 10-15 minutes before the close by email. You can set up an alert, or you get the pop-up on your screen. You have plenty of time to put in any orders if necessary for the index you like to trade. I do it myself as well, and it works really nice. The S&P 500 short term is up 11% for the year. Yes, the market is down 13%. Massive beat. If not good enough, it's fine. Somebody else might be better. That's great. Again, this is lazy boy trading. Anybody can do it, and it can help you with discipline if you need some help get going. Intermediate term, it's about 10% up or 9%. So averaged, we're up 10% year to date, which completely beats the index massively. This is for the S&P 500. I have the Dow Jones, semiconductors, IWM. I don't have the statistics for those. Expect them to be about similar. This is about the similar results because most of the signals are about the same. Yes, there are losing trades, absolutely. Absolutely, but if you just stick to it, you'll do fine. And you can say, oh, I'm not paying for being down 6%. Well, then you don't pay anything and you'll be down 21% for buying holders. That's the difference. A good trading system is one that can minimize your losses, and a really good trading system is one that actually can give you profits in a down market. So again, I just wanted to show you that there's other ways to make money besides Elliott Wave, because this is, of course, Elliott Wave trading. What I show you, really tracking the market. And again, this week we had the proverbial curveball. I was anticipating it. I knew one would be coming. I had too many calls in a row correct. And then when I know one, wasn't incorrect. We did not get the breakout, but this definitely made me reassess the chart. So I still think we're in wave 5 of CO4. We have to drop below, I believe, 3,800 to really start wondering what's going on. Then I will review the chart and say a much larger top has been struck. Again, the price action since the highs in November for technology and since January for the indexes still looks quite overlapping, non-impulsive to me. I must admit, unless we're in some very nested, weird, bearish setup. But as always, don't worry about those. Worry about your trades, worry about your stops. Still looks like pretty good here with a minor tweak here for the ABC for wave 4 and now in wave 5, which ideally should, of course, bottom right where it should have, but it can extend a little bit lower. Extensions can always happen. Same for the NASDAQ100 and, of course, regular NASDAQ. We did not break above the blue line on a closing basis. Didn't happen. We did make a slightly higher high, but not on a closing basis. We did not close where we had to. This is the same blue line, 15, 16, 17. That should be ideal, in my humble opinion. The equal weighted indexes and the other ones also show that we still should anticipate a final fifth wave. If we really start breaking down, you'll be the first to know. Again, that's not my preferred point of view. Other people don't see it either. Some do, but the ones that I truly respect and have been around for many years, if not decades, do expect another rally. So let's see what we're going to get on Monday. I think we have adjusted the charts nicely. Again, it does require now a break back above Wednesday's high to confirm the low is in place. I'm going to diligently track this last 5 of a C wave to see if we can get a little bit better into this ideal target zone. I don't care so much about overshoot intraday. And then once we have completed this wave 5, it's time to track again 5 waves higher without any overlap, just as we did here in January, just as we did here in February, March, and just as I tried to do here from Wednesday on, but it completely already fell out of bed on Thursday. Unfortunately, I myself was in bed on Thursday, not feeling well at all. So again, sorry about my throat and the coughing. Apologize. And then once we've completed wave 5, again, after 5 waves lower, expect at the minimum 3 waves back up. No overlap yet. We haven't broken to the upside, so the market decided to continue to subdivide lower. Again, apologize that I misinterpreted a little bit of this hourly price action. It just shows you that if you can get a third and a fourth wave wrong, how that transpires going forward, but then we have the price levels to look at. This is where the price levels will tell you if this is indeed 3, 4, and 5 to confirm it. And it wasn't, excellent. And now we'll see if we get another break higher. Yes, then we have it fully confirmed, but I prefer to see this wave 5 of 5 of C go a little bit deeper. I think the charts are nicely set up for it. They still look like they want to go lower. All right, that's all I have for today. Thank you so much for listening. Let's see what we get on Monday. Have a great rest of your weekend. Take care, trade safe, all the best. Bye.